Hello students. Today we're going to be talking about bad debt expense. When a company does business with another company, they do everything they can to determine if the customer that they're dealing with is creditworthy before they extend credit through accounts receivable. However, no matter how much work they do, there are always some accounts that are not paid. So we have to come up with a method to actually record the write-off of those accounts, and that's what we're going to do today. We have two methods that we use. We either use the direct write-off method or the allowance method. Now, under the direct write-off method, we do not do anything until we deem or decide that the account is not going to be collected. And at that time, we will debit or charge expense and we will write off the account. Sometimes, however, it's going to take a while to determine that the account is not collectible because we're going to do everything that we can in order to collect it, which means that we might even go into another accounting period before we actually collect the debt or decide to write it off. Since this is true, this is violating our matching theory under accounting and does not meet generally accepted accounting principles. So therefore, most companies use the allowance method, which does meet the requirements for the matching theory, because what we're doing there is actually estimating what our uncollectibles are going to be. Larger companies would use the allowance method, whereas smaller companies might use the direct write-off method. Okay? What I have here are some journal entries that we would have in certain instances, which I have listed here, and we will go over these. The first thing I have is if the account is written, when the account is written off, what do we do? What do we actually charge? And under the direct write-off method, we're going to be charging or debiting bad debt expense and, of course, crediting the account receivable. Under the allowance method, however, we would be debiting the allowance account, the allowance for doubtful accounts, and crediting accounts receivable. Now, you might ask, what type of an account is that allowance account? And it is a contra asset account. It is contra to accounts receivable. And we would actually use that account to come up with our net realizable value, which is what goes on the balance sheet. That is the amount that we actually expect to collect from our accounts, and the net realizable value is the account receivable balance minus the allowance. Okay? All right. The next item that we might have is if the customer decides to pay after the account is written off, or they might decide to pay for part of the account. Then we're first going to reinstate the account for the amount that they're paying. And to reinstate it, we're going to debit accounts receivable, put the account back on the books. We're going to credit the account that we used to charge it off. In the case of direct write-off, that would be bad debt expense. In the case of the allowance method, that would be allowance for doubtful accounts. So we put it back on the books, then we accept the cash and record the cash payment, which is a debit to cash and a credit to accounts receivable in both cases. Okay? The next thing that might happen is, excuse me, if we estimate, or when we estimate the bad debts, and we do that at the end of the accounting period before we do the financial statements. For the direct write-off method, we have no entry there because we're not using an allowance and we're not estimating bad debts. But over here under the allowance method, we would estimate what our bad debts are going to be, come up with an amount, and then we would debit bad debt expense and credit the allowance for doubtful accounts. That would be our entry. Okay? Now, the next thing I have is methods of estimating bad debts. Now, we're not going to do that under the direct write-off method because we're not going to make that entry. But under the allowance method, we do have two ways that we're actually going to make that estimate, and that is the percentage of sales and the analysis of receivables. Now, under the percentage of sales, what we're going to do is take a percentage of our actual sales. The percentage that we come up with is based on historical information, what's happened in the past, and we take the amount of the actual calculation, the percentage of sales, and that is the amount that we put in this journal entry right here. Okay? The other method is analysis of receivables. Now we can do this in two ways. We can either do an aging of receivables, that is, see how old each of the receivables that we have is, put them in categories, and come up with percentage of each of those categories, again based on historical information. Or we can simply just take a percentage of our overall receivables. There's a difference between these two methods in how we actually make the entry. On the second entry, we're going to be adjusting the allowance account to a desired amount. We're going to come up with that desired amount by one of these two methods, and then that will be our balance after the adjustment in the allowance account. So our entry will be the difference between what we want to come up with and what's already there, whether it be a debit or a credit balance. The percentage of sales method is known as the income statement approach, and the analysis of receivables is known as the balance sheet approach. Okay, in the next video I'm going to actually work a few exercises to show you how to apply these two methods.